Breaking tonight, Canada has just done something the markets weren't ready for. For 6 straight months, the country's trade balance has been bleeding red ink. 6 months of deficits. 6 months of analysts on Bay Street shaking their heads, wondering when or if the Canadian export machine would find its footing again. February alone delivered a $5.1 billion gap, the worst monthly deficit on record since August of last year. And then in March, the entire picture flipped. Statistics Canada confirmed on Tuesday what very few economists in Toronto, Calgary, or Ottawa had predicted: a $1.8 billion trade surplus, the first since September 2025. Exports surged 8.5% to $72.8 billion, the highest reading in over a year. Imports fell 1.6%. And just like that, a story that had been dominated by anxiety rewrote itself in a single month. Dear viewers, this matters far more than a headline number buried in a quarterly report. Because behind these figures sits something much larger. A story about who supplies the world when the world is on fire. And right now, that supplier is Canada. Let me walk you through what actually happened. The biggest surge came from metallic and non-metallic minerals, a category most people never think about until it suddenly matters. Mineral exports climbed 24% in a single month to a record $15.3 billion. Within that, precious metals, gold, silver, platinum, rose 37.7% to $3 billion. The largest single driver? A massive uptick in Canadian gold shipments to the United Kingdom. Translation: London is hoarding metal, and Canada is the one filling the vault. This is the part that gets lost in most coverage. The world's central banks have been in a quiet buying frenzy for over a year. Gold has become the silent currency of a fractured global order, a hedge against war, against inflation, against the slow erosion of trust in fiat reserves. When that demand intensifies, somebody has to mine it, refine it, and ship it. And Canada, with mines in Ontario, Quebec, British Columbia, and the Yukon, has quietly become one of the most reliable suppliers in the Western world. What makes this even more remarkable is the timing. Gold prices actually fell during March, yet Canadian gold exports rose anyway. That tells you something the price chart doesn't. The demand is structural, not speculative. Foreign buyers aren't chasing momentum, they're stockpiling. And they're stockpiling from Canada. Now let's talk about oil, because that's where the geopolitics really sharpens. Crude oil exports jumped 15.6% to $17.1 billion in March. That's the highest level Canada has recorded since September of 2022. And the reason is something nobody in Ottawa wants to celebrate publicly, but everyone understands privately: the war in Iran. When Iranian energy infrastructure took damage and serious questions emerged over the Strait of Hormuz, that narrow choke point through which roughly 20% of the world's oil passes every single day, global prices spiked. Importers from Asia to Europe to the United States started scrambling for alternative supply. And Canada, sitting on the third largest proven oil reserves on the planet, suddenly looked very different to the rest of the world. Translation: when the Middle East burns, Canada becomes indispensable. This is the part of the story that doesn't make the front page in Toronto, but it should. For years, critics inside and outside this country have argued Canadian oil was stranded, irrelevant, or destined for obsolescence. March's numbers are a quiet, factual rebuttal. Trans Mountain is pushing barrels to Asia. American refiners along the Gulf Coast are pulling more Western Canadian Select than at any point in the last 3 years. Energy is back at the center of Canadian economic identity, not because Canada chose this moment, but because the world chose it for her. And the United States is paying close attention. Canada's trade surplus with America widened 8.3% in March to $7.1 billion. That, too, is the highest level since September of last year. Higher crude oil exports drove it. So did Canadian-built passenger cars and light trucks rolling off assembly lines in Ontario. American consumers, American refiners, American supply chains, all leaning more heavily on the country to the north, even as political winds in Washington keep shifting beneath their feet. If you're following Canada's economic and geopolitical positioning, hit subscribe before the next chapter of this story breaks, because the coming 12 months are going to define this country for a generation, and you don't want to be reading about it after the fact. Now let me slow down and give you my honest read on what's actually happening here. The numbers are genuinely good. They're better than expected. BMO senior economist Shelley Kaushik called the surplus stronger than markets had priced in, while also noting it wasn't entirely shocking given WED. Here, energy prices have gone. She made an observation worth repeating. Canada has a relative advantage as a major energy supplier. That isn't cheerleading. That's a market economist saying out loud what the data has been suggesting for months. But Kaushik also issued a warning that deserves to be heard alongside the celebration. Commodity-driven surpluses can vanish as quickly as they appear. If the Strait of Hormuz reopens, if Middle Eastern energy infrastructure rebuilds, if oil prices retreat toward pre-war levels, Canadian crude exports could, in her words, come back down to earth. The Bank of Canada, in its latest monetary policy report, expects global oil prices to decline over the long term. So the real question isn't whether oil prices fall, it's how fast and how soon. And that brings me to my own analysis. What we're watching right now is not a fluke, it's a preview. Canada has spent the better part of 2 decades arguing with itself over what kind of economy it wants to be. Resource superpower or post-carbon innovator. Continental energy partner or sovereign producer. Quiet middle power or assertive Western anchor. The March trade numbers don't resolve that debate, but they reveal something undeniable. In moments of global stress, Canada delivers. Not promises, not press releases, actual barrels, actual ingots, actual vehicles rolling across the border. That is a strategic asset, and it's one this country has historically been bad at recognizing in itself. Dear viewers, here's what should genuinely worry policymakers in Ottawa right now. The second this commodity tailwind shifts, all of these numbers can soften fast. And the first quarter of 2026 already tells a more sobering story. Despite March's surplus, the quarterly merchandise trade deficit widened to $6.5 billion, up from $4.2 billion in the previous quarter. Imports climbed 4.6% year over year. Exports only rose 3.5%. The structural trade picture is still weaker than the monthly headline suggests. Desjardins economist L.J. Valencia flagged the bigger threat hanging over all of this: the upcoming review of the Canada-United States-Mexico Agreement, CUSMA. Businesses on both sides of the border are already struggling to plan. Exporters can't model investment decisions when they don't know what tariff regime they'll face in 12 months. And if the renegotiation collapses into a no-deal scenario, Valencia warned, the entire Canadian growth trajectory takes a major hit. Translation: one bad trade negotiation in Washington could erase everything March just delivered. This is where Canadian policy needs to be sharp, fast, and unromantic. The surplus is real. The advantage is real. But neither is durable unless this country uses the window to lock in the structural pieces. Pipeline capacity to tidewater, port infrastructure on the West Coast, critical mineral processing facilities, refinery upgrades, faster permitting timelines, and a hardened CUSMA negotiating position that makes Washington pay for instability rather than rewarding it. Play this moment correctly, and March 2026 becomes the turning point. The month Canada stopped apologizing for what it produces and started monetizing it on its own terms. Miss it, and March 2026 becomes a curiosity, a footnote, a reminder of what could have been. And let me be clear about one more thing, because almost nobody in this country is saying it out loud. The gold flowing to London isn't just a transaction. It's a signal. London is the world's largest physical gold trading hub, and most of the metal moving through its vaults doesn't stay there. It gets repackaged for ETFs, held in custody for foreign central banks, or shipped onward to the countries actually building their reserves. And those buyers are not the ones most people would guess. Poland leads the global accumulation push, sitting on a multi-year plan to reach 700 tons for national security reasons on NATO's eastern flank. China, India, Kazakhstan, and Brazil keep adding quietly to their own holdings. The global financial system is de-dollarizing at the margins, and Canadian mines are part of how that's happening. Every kilogram of refined gold leaving Canadian soil right now is settling somewhere in the architecture of the next monetary order. That makes Canada more than a commodity exporter. It makes Canada a participant in the design of the next financial system. And the conversation hasn't even started in Ottawa. If this is the kind of geopolitical read on Canadian affairs you can't get from the daily news cycle, stay with this channel. We track this country's positioning in the world every single day, and we're just getting to the part where things accelerate. So where does all this leave us tonight? Canada has its first trade surplus in 6 months. The drivers are oil and gold, two commodities the world is rediscovering precisely because the world has become more dangerous. The surplus with the United States is widening. Auto exports are recovering. Mineral exports are at all-time highs. And underneath all of it, the structural quarterly deficit reminds us this advantage has an expiration date unless policy moves to extend it. The question facing Ottawa, Calgary, and Toronto right now is simple. Is this a moment, or is this a turning point? The world is offering Canada a hand, and history rarely offers a second one. This is Canada Next. I'll see you tomorrow.